Ever feel like you're just staring at a wall of blinking numbers when you look at the stock market? One day it's soaring, the next it's tanking, and it just feels impossible to get a handle on? Well, what if I told you there's actually a hidden rhythm to all that chaos? Today, we're going to decode the predictable cycles that really drive the market so you can stop guessing and start, actually understanding what's going on. Let's jump in. I mean, seriously, some days it just feels like a total coin flip, doesn't it? Stocks are flying high in the morning and then bam, they're in a nosedive by the afternoon. It can make you feel like you're just throwing darts at a board, hoping something sticks. It's just so random. But here is the big secret. It's not random. Not at all. The market actually moves in these surprisingly predictable cycles. And the key, the real Rosetta Stone to figuring it all out, is the economy. And that connection right there is exactly what we are going to unpack. So, let's talk about this market rhythm. Honestly, you should think of this as your secret weapon as an investor. Why? Because when you get it, you're no longer reacting emotionally to every scary headline or sudden drop. It gives you the perspective you need to stay cool and make smarter moves, especially when everyone else is panicking. Okay, so what's actually powering these cycles? Well, it really just boils down to a combination of three big forces. First, you've got the hard data, the actual economic conditions. Then there's the human element, how investors are feeling, what we call investor sentiment. And finally, the thing that matters most to stocks, corporate earnings. Are companies actually making money? When you put all those forces together, they create two very distinct phases in the market. You've definitely heard the names before. It's time to officially meet the two heavyweights, the bull and the bear. And this chart really lays it all out. A bull market, that's when things are great. Prices are going up, investors are optimistic, and the economy is expanding. A bear market is, well, it's the grumpy opposite. Prices are falling, pessimism is everywhere, and the economy is contracting. Now, here's a little bit of good news. Historically, the good times, the bull markets, tend to last a whole lot longer than the bad times. So, how can we really tell if we're in a bull or a bear? Well, think of it like looking at the dashboard of your car. There are a few key gauges, these vital signs, that tell us how healthy the economy is and, just as important, where it might be going next. The biggest gauge on that dashboard is GDP, which stands for Gross Domestic Product. You can pretty much think of this as the economy's final grade on its report card. It's the total value of everything a country produces. So if GDP is growing, that's a really good sign. Next up, you've got the unemployment rate. This one's pretty straightforward, right? A low unemployment rate means more people have jobs and paychecks, and that's a huge sign of a strong, healthy economy. And last but not least, we have consumer confidence. Now, this one is all about psychology. It's literally a measure of how people feel about the economy and their own finances. And trust me, feelings matter a lot. Because when people feel confident, they go out and spend money. And that spending is the fuel that keeps the whole economic engine running. Okay, here's a crucial point. Not all of these indicators work the same way. Some are what we call leading indicators, like consumer confidence. They try to predict where we're going. Others are lagging indicators, like the unemployment rate, which basically just confirm a trend that's already happening. The best way to think about it is this. Leading indicators are like looking out the windshield of your car, while lagging indicators are like looking in the rearview mirror. You need both to drive safely. All right, so we've got our dashboard, we've got our indicators, but how does a boring old GDP report actually make your stocks go up or down? Let's connect the dots between that economic data and your portfolio. It all happens in this little three-step dance. First, a piece of economic data gets released. But way before that happens, Wall Street analysts have already placed their bets on what that number will be. And this is the most important part. The market doesn't really react to the number itself. It reacts to the surprise, that difference between what everyone expected and what actually happened. This quote right here nails the single most important concept you need to grasp about the market. It is a forward-looking machine. It's not trading on what's happening today. It's constantly trying to price in what the world is going to look like 6 or 12 months from now. This explains that weird thing you sometimes see where good economic news comes out, but the market tanks. It's usually because the news wasn't as good as investors were hoping for. But generally speaking, the basic logic holds true. Strong data, like low unemployment or solid GDP growth, usually means the economy is humming along. And a healthy economy means companies are probably making more money. And when companies make more money, well, their stocks tend to become more valuable. It almost always comes back to earnings. Okay, that was a lot. We've talked about cycles, the economic dashboard, and how it all connects to the market. So, what's the one thing, the main idea, that you really need to walk away with? Let's boil it all down. Here it is. The number one rule: focus on the trend, not the daily noise. It is so easy to get freaked out by one bad jobs report or a single red day in the market. But your job isn't to overreact to every little blip on the radar. It's to step back and ask a simple question. Looking at all the data, is the overall economic trend pointing up or is it pointing down? That bigger picture is what truly matters. So, I'm going to leave you with a little bit of homework. Now that you have these tools, you know about the dashboard, you know about the cycles, go look at the latest economic news. Check out the recent GDP numbers, see what unemployment is doing, find a consumer confidence report. Based on everything we just talked about, what cycle do you think we're in right now? The cool part is, the answer isn't something you need to wait for some expert on TV to tell you. It's something you now have the framework to start figuring out for yourself.